Welcome to this PayTrace webinar. My name is Sam Johnson. I'll be your trainer today. Um, Looking over the live audience here, we've got a lot of familiar names, which is very cool. I haven't seen some of you guys in a bit, but also seeing a lot of new names on here. So special welcome to you guys. If you are new to PayTrace webinars, just some quick housekeeping to go over. These webinars are pretty quick. They're typically about 30 minutes long, about 25 minutes worth of content, 5 minutes for Q&A at the end. You will notice as you are logging in, you are muted. It's not because I don't want to chit chat with you, but we do have a large audience today, so we want to reduce distractions and we want to make sure that we stay on track. So, my ask of you is if you have questions, comments, emotional outbursts, I encourage you, share that with me. Open up the Q&A box on your Zoom panel. You'll be able to get in there just like Greg and Barry have. Hey, Barry. And we'll carve out some time afterwards. If I can't get to your questions today, no worries. I'm going to have my team follow up with you. I'll personally be following up on some questions and making sure that you have all the information that you need to be successful. Sound good? All right. So today's webinar is going to be, I think it's fun. Some people think it's dry. We're going to be talking about interchange, kind of the foundations of credit card payments. And this is a big deal, especially in the B2B payment space, where we can have a pretty large impact on interchange if we are an ISO or a processor, or if you're a merchant, you actually have the ability to save some money if you have some foundational knowledge about interchange. So the agenda for today's course is we're going to be diving into first the foundation of interchange. What is it? It's not necessarily common knowledge. If you're in the payment space, this is one of the first things that you learn. But if you're not in the payment space, this is super important and can help you out quite a bit in the long run. And it's also really beneficial as a payments professional to be able to explain this to your clients. So we're going to cover some basics. From there, we're going to move into some of the exciting stuff, the level two and the level three processing, which revolves primarily around cost savings for a lot of folk. And then we're going to get into some of the new stuff. A lot of you have probably been hearing about Visa CEDP. Um, it's been kind of a hot button item for the last year or so, and it continues to have a pretty big impact on the payments industry. So we're going to take a look at what is it, why is it here, and how can we work with it. So, like I said, try to get in within half an hour, but there's a lot of content on here today, guys. So, starting with the basics, what the heck is interchange? When I was new to the payment space about a decade ago, this is again one of the first things that my manager is like, you need to learn this. I was like, great, I'll poke around online. Let's do some Googling. So I started with the card brands, went to Visa, went to Mastercard, and I said, what's interchange? Big long definition. This is directly from their website. Visa says that interchange is something about transfer fees between financial institutions to balance and grow the payment system for the benefit of all participants, blah, 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 blah. A lot of stuff on here. It's a lot of words that doesn't really tell you anything. So I said, I don't get this. Let's go to MasterCard. And I'm not supposed to play favorites, but I like MasterCard's definition much better. They use smaller words and shorter sentences. So not argue, they define interchange as a small fee. I'm going to put the parentheses around this or quotations because small is a relative term. It's a small fee paid by a merchant's bank to a cardholder's bank to compensate the issuing bank for a portion of the risk and costs it incurs. So, based on these two definitions, we have an understanding interchange is something about fees and it's something about banks. That's it. Flowchart. I'm a visual learner. I think flowcharts do a really good job of explaining things, how it flows. So if I've been using this for a long time, but I actually stole this from a lawsuit between Visa and Walmart probably 20 plus years ago. But it's still current, right? That doesn't change. And I think it does a really good job kind of painting the picture of a credit card transaction, how the money moves and who's touching everything, and where the dollars start and where it ends. So we're going to walk through this flow chart of what we're going to call the four-party system of interchange. On the left-hand side of this, we have the cardholder, the customer, the buyer, represented by their bank known as the issuer or the issuing bank. And then on the right-hand side of this, we're going to have the merchant, right? The business of record who's going to be accepting that payment, or the supplier, and they're represented by their bank known as the acquirer or the acquiring bank. But basically, let's just say this isn't a card holder, this is a cash holder, and they want to pay with cash money for goods and services. Pretty simple. They're going to send money or hand money, I guess, to the merchant. Merchant provides goods and services, transaction complete. However, when we introduce plastic into that equation, that's when things get a little bit more complex. So the customer is now going to pay by card. Merchant's going to key it in, swipe it, tap it, chip it, whatever they're going to do to get that processed. At that point, money doesn't just magically appear in their bank account. If it did, that would be super cool. Sounds like the industry's working on that. But for now, there's still a process. So what happens at this point is the cardholder's bank, the issuer, is going to transfer funds over to the acquirer, who will then provide those funds to the merchant. So just kind of a little bit of a workaround way to get from point A to point B. But for those of you that are on this call, if you know anything about banks, is that banks don't do anything for free. And this is a service. So we have to call that out. But if we add numbers to this, let's just say this was a $100 transaction. Issuer transfers that money. They're going to keep a small fee for themselves in the form of $1.70. So they're going to take the rest of that money, transfer it to the acquirer. The acquirer also is going to retain a small amount of money, and the remainder is going to be passed off to the merchant. Now, when we talk about everything holistically, um, every single time a merchant accepts a credit card transaction, there's going to pay a percentage in fees. And that's what we call the effective rate. With that, typically the largest portion of those fees is made up of in what's called interchange, which is that initial $1.70 that the issuer took, right? So all that to say, transaction started with 100, finished up with $97.80. Majority of that came out of interchange. So I like to be able to explain this in pretty much layman's terms to a merchant. If you're hanging out at a bar with your buddies and they're like, "What do you do?" You're like, "Well, I do credit card processing." Well, what does that mean? You can show them this. Makes you sound really smart. Now, all that to say, interchange isn't evil. It is a necessary thing. Um, and to highlight that, I went to Mastercard and found a good article that explains what the world would look like without interchange. Um, Specifically in the US, we rely very heavily on interchange for a couple reasons. But Mastercard argues that if interchange went away, if it was eliminated, there would be kind of a ripple effect. Things would change in how we make payments. The number one thing that would occur is cardholders would start paying fees. Now you're probably like, well, I do that sometimes today, right? If you go to a merchant and they charge you, 3% surcharge, that's not what we're talking about. That's essentially offsetting interchange costs. What we're talking about here is that to have that line of credit and to use it, there's going to be a cost associated with it, right? That's going to the card issuer or something. Today, typically, right, we're not paying on like a per transaction basis, or when we get our credit card statement, there's not an additional fee for interchange, right? Um, we might pay an annual fee to use that card, but that's mostly it. So interchange goes away. Now there's a cost to use a credit card. Next up on here is the one that I think people would get really upset about is that rewards programs would go away. Personally, I've got a couple credit cards. They're usually tied to some sort of airline miles. I don't think I've paid for a flight in about 9 years, at like actual dollar money, which is nice. Um, you know, D Whoever Delta Airlines doesn't just give me miles because they're altruistic and they think I'm a pretty good guy. They use it because they're making revenue off of the interchange when I spend that card, right? Interchange is helping subsidize those benefits. That goes away, right? Those programs are going to be lessened quite a bit. You're not going to get those rebates. You're not going to get those airline miles. You're not getting cash back. Um, right? That pot's going to dry up. So less incentive to use cards as a buyer. Issuer innovation is stifled. One thing about this industry that's kind of cool is while payments as a whole is kind of a commodity, right? The technology behind it is evolving rapidly, right? For those of you that have been in this space for a while, you probably, a while, you might remember the imprint readers, you might remember the Zon Juniors, kind of the early technologies. Today, now there's Apple Pay, Google Pay, near field communication, there's peer-to-peer payments with Venmo and Zelle. There's all sorts of cool stuff that's out there. Um, right? So we continue to innovate. MasterCard argues that a lot of that is facilitated by the revenue generated through interchange. I don't know, feels a little squishy, but it's something. Now, these first few bullets are primarily, I would say, consumer focused, right? The actual buyer. Um, the big thing for merchants, right? The businesses that are really paying for interchange is that you know, interchange helps cover the costs and risks of processing transactions. There's fraud. There's a lot of fraud in credit card transactions. It's just kind of the nature of the beast. But interchange is there to be kind of like fraud insurance for the most part. If the merchant does things correctly and something happens that shouldn't happen, they're not on the hook for any sort of costs that are incurred for that. That's how we expect it to operate. However, interchange goes away, so does that, safety net, if you will. So if there's something that happens, you know, you're out of luck, pal. So all that, you know, all the risks falls and is shifted over to the merchant. And then lastly, MasterCard argues that transactions would be just slower and less efficient without interchange. So all that to say, there's two sides of it. While yes, interchange has a cost, we want to mitigate that cost as much as possible. It does have a benefit. All right. So now that everybody here has the same foundational knowledge on interchange, let's get into how we can impact this. How can we utilize interchange to add value to merchants, right? So to get a good understanding of some things, I want to jump in our time machine and go back a few decades because we're going to start talking about B2B payments. And when credit cards were a first introduced into the market, right, new technology, it was really easy to get individual consumers to start putting away their checkbooks and using cards. Um, because it's convenient, you get great reporting, you get more spending power, you get all sorts of stuff. However, it was very difficult to get more of the commercial purchasers to switch up their payment practices, right? They didn't necessarily see the same benefits that individual consumers would get. And to the card brands, that was an issue, right? They're missing a huge market share by not getting the commercial side of spending. So what they did is they did some market research and what they found out was the needs of a commercial buyer were vastly different than an individual. So the pain points that they were seeing was a better need to understand their purchasing patterns. So how are they spending money today, right? Overall, right, they want to improve their purchasing performance. So um, right? How can we get more visibility into how we're spending and have that transition into, well, how can we be more efficient with our dollars, right? How can we um, get more bang for our buck? How do we, spend the dollar, um, just spend better overall? Also, there's this idea of meeting partner agreements, so working with different vendors and having contractual obligations with regards to, making payments within a certain time frame. That's super important. You want to stay compliant with the people that you buy from. And then lastly, and definitely not least important, is being able to monitor employee spend. So if you give somebody a blank check and say, hey, go buy what you need to, um, right? Businesses might get taken advantage of. So being able to make sure that employees are compliant with their spending and spending where they're supposed to be, right? Pretty big challenges. Visa and Mastercard said, hey, we recognize that these are pain points for businesses. If you start using our commercial credit cards, we're going to get you a bunch of data. We're going to get you data that's going to show you all of your purchasing patterns. We're going to get you data so that you can have better purchasing performance, that you're going to meet your vendors, and that you can put limits on what your buyers or your employees can and can't do. A lot of good stuff. Businesses said, great, let's do it. All this is awesome, but it kind of brings up the question, where are the card brands getting this data from? And that's where level two and level three come in. What the card brands did, specifically Visa and MasterCard, they developed a carrot and stick program called level two and level three. And what they did is they went to the merchants accepting these B2B credit card transactions. And they said, hey, merchants, if you provide us more data on these credit card sales, we are going to in turn reduce your interchange rates, right? You give us the data that we need to pass on to the customers, we'll give you a cost break, right? Kind of a win-win-win situation. Card brands get more people using their cards. The card holders, the buyers, are going to get more rich data, and the merchants are going to get cost savings. Pretty cool. Now, let's try to understand what this data actually is. On every single credit card transaction, doesn't matter if it's business to business, business to consumer, right? It's going to include what's called level one data. Super basic stuff, realistically, right? It's going to have the credit card number. It's going to have timestamp of the transaction. How much was that transaction for? And then some information on the merchant themselves. What type of business are they and where are they located? Now, right, you take a look at this holistically within the economy and think about all of the thousands, tens of thousands, millions of transactions that are occurring every minute of the day, and all of this information that gets remitted back. The big data that the card brands have at their disposal is insane, right? The amount of insights that they have on the economy is extremely powerful. And that's just on level one. When we go up the information ladder, you'll get to this thing called level two. And as we're going to hear in a few minutes, level two isn't really as popular as it used to be, but it's still around in a lot of cases. And it's pretty simple. Really, all level two requires is the merchant to add on some type of sales tax amount and some type of information on the customer themselves. If a merchant can add this data on some of their transactions, they have the ability to potentially save some money. And I'm just going to call out PayTrace, I think does this really well, but most solutions out there on the market today can do level two. It's not that challenging. Now, where things get really tricky is with this thing called level three processing. Level three is kind of the pinnacle of interchange optimization, right? Meaning that if a business can qualify for um, level three rates, they're going to have the lowest interchange. However, on the flip side, there's a lot that's required. Level three is everything on those previous two slides plus potentially up to 21 additional data fields. Uh, right? It's a lot. You can try to simplify it and say, it requires summary or enhanced data as well as line item detail. Um, but you might need to be able to supply up to 99 unique line items per transaction. Visa and Mastercard don't have complete parity on the data that they want. The processing networks on the back end have different ways that this needs to be packaged. So all in all, while level three is great, and we'll talk about that from a monetary perspective, it's challenging. It's super complex. So just keep in mind there's a lot that goes into this. However, the financial benefit is significant. If you want to take a screenshot of this, I'm gonna provide some resources on where you can find current rates here in a little bit. This is current as of this recording. So this is an example of a Visa commercial credit card and what those cost savings could look like. So if you look at a merchant accepting this card today, if they weren't adding in any level two or level three data, they're probably going to qualify in one of these boxes depending on how they're running that transaction. Somewhere between 2.5 to about 3% on just the interchange costs alone, right? Pretty significant. Might seem like a small percentage to some, but when you're working in um, different industries and verticals that might be operating on very tight profit margins, 3% can make a huge impact to the bottom line. Now, business that's accepting these cards, if they're able to add in all of that data from the last slide that we just looked at, all of a sudden can qualify for rates as low as 1.75%. Right? If you look at do the math, it's pretty easy math, but it could be anywhere from 75 basis points all the way up to 120 basis points worth of cost savings, right? That's significant, especially when you think about a lot of B2B businesses. They're not operating on, small $10, $20 transactions. These are usually thousands, tens of thousands, in some case, hundreds of thousands of dollars per sale, where, 100 basis points could be somebody's salary at the end of the day. So that's a big thing. MasterCard. Ah, I forgot to change the title on this one. This one's MasterCard, not Visa commercial card. Very similar. They're typically more or less in lockstep with Visa. Um, right, 2.5 to about 3%, data rate 3, synonymous with level 3, about 1.9%. So, right, cost savings are great. What I like about this on both sides of the coin, right? You have the merchant benefits and you also have the payments professional benefit. Is on the merchant side of things, right? They can save money through level three. Um, but on the payment side of things, right? Very commonly, it's more or less the race to the bottom for a lot of folk, right? How can we reduce our margins, our rates as low as possible? With this, if we can provide solutions that can help merchants achieve level three in these cost savings, you can also essentially protect your margins. We can save our customers, our clients money without needing to cannibalize our own value. So it really is a win-win. Now, all this is fantastic, but begs the question, why isn't everybody doing this now? And there's a couple reasons. Number one reason why people aren't doing it now, actually three, we'll say three. One, they don't know about it, right? Merchants are unaware of this. Even some payments professionals are unaware of some of these programs that are out there. Two is, like we saw earlier, there's a heavy lift that goes into this, and that lift occurs in time and data entry and trying to get all of the necessary fields submitted on every single transaction. It can be a lot of work, right? Especially if you're running high volumes of transactions. Um, it's a time suck, right? Nobody likes manual data entry. But number three, and this is the more current one, is that there's been some um, kind of compliance shifts in our industry. Up until last year, I'd say for the last few years, there have been a good handful of technologies and merchants that have essentially been gaming the system. And what I mean by that is rather than putting in accurate, legitimate data on these level three transactions, been kind of circumnavigating that by putting in um, false, fraudulent ones and zeros, kind of, not good data, not accurate data. And in this new age of AI and machine learning, what Visa has done is they've said, hey, that's not good enough anymore. We're going to start validating, we're going to start auditing this data that's coming in. And if you're not giving us real data, accurate data that passes our tests, um, you don't get the access to the best rates, right? You're not going to qualify. So that's become a big issue. Now, Visa's put a name to this verification program and they've called it CEDP, which stands for Commercial Enhanced Data Program. So the goal really ultimately is to get better data, right? If they're not getting good data, this whole program means nothing, right? It's completely saturated with garbage. So the goal overall is to make sure that real good data is being sent in. So what Visa has been doing now for a while is they've been looking at the data that merchants are sending in for level three. And they're running it through their AI and basically saying either thumbs up, this is good, or thumbs down, this is bad. And we need about a month's worth of thumbs up data for you to be CEDP verified and can have access to these level three rates. So if you're not verified, you do not get level three, regardless of what you're trying to send in. And then lastly, and this kind of went a little bit under the radar, is elimination of level two. That's why I kind of explained level two's not as popular anymore. It's because it's gone for Visa. They actually eliminated it this year, um, which got a lot of people panicked. But the nice thing about level two going away is those cards that used to be only eligible for level two have now been upgraded to be eligible for level three, which as a kind of a net savings is actually going to be a net positive for most merchants. So here's the timeline. This has been happening for a while now. Um, this verification process that they rolled out actually started of April of last year. Nothing happened in terms of qualification at that time, but that's when they started actually, right, combing through the data, seeing is this real or not. When this really became, I guess, front and center for merchants was in October of last year. This is when they basically flipped the switch and said, "Hey, this new qualification is applicable now. If you're not verified, you're not getting level three." So at that point, merchant statements, right, if they weren't doing things correctly, were shooting up through the roof, right? Essentially, those 1.75% interchange transactions were now downgrading upwards of a whole percent. And then early on this year, that's when they discontinued level two completely. So, if you're a merchant, might want to go look over your last year's worth of statements, see how that's changed. Also, if you're a payments professional, you might want to audit your accounts and make sure that they're doing everything as it should be. So with that said, PayTrace, as I'm sure most of you are aware of, we're kind of the B2B payment experts and have kind of had the moniker of being level three experts. We haven't been sitting back and been quiet on this. We've actually been at the forefront developing our product to make sure that it is Visa CEDP compliant and that there would be no disruption to any of our merchants' processing, right? We want to make sure that everybody still has access to those best possible rates with the least amount of friction. So our solution to this has been our what we call our product list. So what I'm going to do is I'm actually going to hop over into a quick demo to show you exactly what this is and how we help our merchants achieve level three. So we're going to log into my test account here. See if I can get my password correct. First try. That usually doesn't happen. On our accounts now, you will see under this account drop-down menu this link that says enhanced data. And what we've developed is this tool called a product list, where we want to still pass on the most accurate data that's going to pass Visa's test, right? We want to work hand in hand with the card brands. We're not trying to beat the system. But at the same time, we still want to make this very accessible for our merchants. So what the product list is this is a section where a merchant can add in a representative sample of all of their, goods and services that they sell. For my fake business, I sell golf stuff. I have 7 products that I sell. Pretty simple. Some merchants might have a handful, they might have thousands. Um, Once these are in here, we also ask that they're prioritized. So whatever sold the most, um, right, we'll put in there. And then lastly, all of these things only need 5 fields of information. Needs a putter, or needs a product label, right? What are we selling? What's the product code that we want to associate with this? What is the commodity code of this good or service? And then what is the cost per unit and that unit of measure? Once those things are entered in and we have our products, what PayTrace is going to do is when a level 3 transaction is processed, we're not going to make anybody manually enter in data, right? This is a one-time setup on an existing account, usually right when you build the account. And what we're going to do is we're going to take that total sale amount, we're going to reference the product list, and we're going to say this is a $200 sale. Looks like Sam probably sold 2 putters. So we're going to apply 2 line items for putters onto that transaction, right? So we're going to take all of the things that are on that database and apply what we believe by our business logic is the correct, accurate information. So Visa gets good data on actual products and services that the merchant's selling. The merchant's not having to do anything, and they get the benefits of, right, essentially cost reduction, cost savings. So truly is a very unique way that we've come about doing this. We've seen some other businesses try to circumnavigate the system in ways that we don't believe are above board. This is probably the best solution that we've seen out there to be compliant with Visa CEDP. And this is great because it also applies to API transactions, or if there's actual line item information on invoice level data that's using Trace AR, one of our other products, we're going to pull that information directly. So again, the most accurate information with the least amount of work. So that's the product list demo. Pretty simple. I usually encourage merchants don't spend more than like half an hour on this. You can import a template if you have a CSV file. But again, just put in, a good sample of what's being sold, so that we can get those level 3 rates. So again, interchange optimization is always at the forefront of what we're doing. Lastly, for those of you that are on this call, I do have some links to resources. When this is uploaded onto our YouTube channel, I'll make sure that we have links to these as well. But we have a lot of information on Visa CEDP and interchange optimization. Blog posts, a couple blog posts. We have some FAQ to make sure that everybody's doing things correctly. Um, Honestly, there's been a lot of FAQ that's popped up around this. And then lastly, one of my favorite resources that I encourage everybody on this call to bookmark, our interchange optimization page. You can find it under payment solutions, links right here on our website. But this is going to have current data on interchange rates. So specifically for Mastercard, you can see eligible cards and associated rates. Same with Visa. Um, all the naming conventions have been changing, the rates have been changing. So every 6 months, when card brand enhancements come out, we make sure that this is current. So definitely feel free to reference this. And these are also downloadable. So if you want a PDF, if you want to share this with your clients, you can download it, save it, send it, whatever you want to do with it. So A lot of good stuff there for you. So at this time, I'm going to take a look at some of the questions. I know we're over my 30-minute limit that I mentioned earlier, but hopefully you found some good value in this course. If you do need to get a hold of anybody, here's some email addresses, a phone number to get in touch with our client services team. If you're itching to get in touch with me directly, again, I'm happy to have a conversation with you. My email that I manage is salestraining@paytrace.com. Again, my name's Sam Johnson. That's salestraining@paytrace.com. All right, so let's take a look at what we got in here. If you missed the first question earlier, this recording will be uploaded on our YouTube channel. Just type in PayTrace on YouTube, like, subscribe, all that good stuff. We've got a lot of awesome content on there. Don asks, can we have a copy of the deck used for this presentation? Yes, absolutely. Just send a request over to that email that I gave you before, and I will try to get you a slide deck that you can use. So Greg's asking, this is a little bit more of kind of a technical question. So is PayTrace going to populate the enhanced data tab leveraging their previous transactions, or is this solely on the merchant to add the products? Great question. So this is really, all of this is at the merchant's discretion, right? They're going to be the ones that are essentially applying the data. We're going to put forth the tools to make sure that everything is qualified. So as long as they're putting some data in that product list, again, I don't want them to take a lot of time. It's just a one-time thing. We're going to ensure that those transactions are qualifying. I believe the current metric is 99.999 something percent of the time is we're getting the qualifications that we expect that we should be getting if they're using the product list. Um, And then Barry, hey Barry, is asking, what business is it of Visa to care or know about what a merchant sells? Well, so if you think back onto that initial thing, talk track about the inception of level three, right? The real reason level three is a program is not because, more data ensures more security and less fraud. That's how it's kind of been pitched in a lot of places. And sure, that's probably a byproduct of it. But really, this data is used to remit back to the buyer. So it's not a Visa's business, but it's really of the buyer's business, right? If somebody's making purchases from another merchant, if one business is transacting with another business, the benefit of level three is actually for the buyer, right? And it's really up to the banks to determine what's actually being remitted, but that's more enriched line item data so that they can be more efficient with their spending. Don, sales training at paytrace.com is my email. Sales training at paytrace.com. Okay, I think we're at time. We're over time. Team, thank you so much for hopping on to this call. I hope you all have a fantastic rest of your week and take care.